Something extraordinary is happening in the precious metals market right now, and most people have no idea it's even occurring. While everyone's distracted by stock market headlines and crypto volatility, a quiet crisis is unfolding in the physical silver and gold markets that could reshape wealth for decades to come. The vaults are emptying, not slowly, not gradually, rapidly. Let me show you what I mean. The London vaults, which have historically held massive reserves of physical silver, have been draining at an unprecedented rate. We're talking about millions of ounces flowing out month after month. The Silver Institute just projected a supply deficit of 115 to 120 million ounces for this year alone. That's the fifth consecutive year of shortfalls. Think about that for a moment. 5 years in a row where the world has consumed more silver than it produced. But here's where it gets really interesting. This isn't just about industrial demand or jewelry. Something deeper is happening in the market structure itself. You see, there are two silver markets operating simultaneously. There's the paper market, where contracts trade on exchanges like the COMEX, representing claims on silver that may or may not actually exist in physical form. Then there's the physical market, where real metal changes hands. And right now, these two markets are telling completely different stories. The paper market has been relatively calm, with prices fluctuating but not exploding. But the physical market? That's where the real action is. Premiums on physical silver have been surging. Delivery delays are extending. And those London vaults I mentioned? They're being drained to feed insatiable demand, particularly from India and Asia. Let me paint you a picture of what's actually happening on the ground. Imagine you're a major silver dealer. You've got clients calling you every day wanting to buy physical metal. You check your inventory. It's running low. You call your suppliers. They're running low too. You look at the COMEX warehouses. The registered silver, the stuff actually available for delivery, has been declining steadily. You check London. Same story. The metal is flowing east, and it's not coming back. Now, you might be wondering, why does this matter? Can't they just mine more silver? Here's the problem. Silver mine production has been decreasing. Not increasing. Decreasing. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. When those operations slow down or become less profitable, silver production drops too. There's no magic switch to flip that suddenly produces millions more ounces. Meanwhile, demand is exploding from multiple directions simultaneously. The solar industry alone is consuming massive quantities of silver. Every solar panel requires silver for its conductive properties. As the world pushes toward renewable energy, that demand isn't going away. It's accelerating. Then you've got the electronics industry. Smartphones, computers, electric vehicles all require silver. The artificial intelligence boom? Those data centers and advanced chips need silver too. Industrial demand isn't some abstract concept. It's real, physical metal being consumed and not recovered. But here's what most analysts miss. There's another layer to this story that's even more significant. Central banks have been accumulating gold at record levels. They understand something that the average investor doesn't. They're watching the same supply dynamics we're discussing, and they're positioning themselves accordingly. When central banks, the institutions that literally create money, are buying physical precious metals in record quantities, that should tell you something profound about where they think this is headed. Let me take you back to a similar moment in history. In the early 1970s, right after Nixon closed the gold window and ended the dollar's convertibility to gold, something interesting happened. For a few years, gold prices were relatively stable. People thought the system would continue functioning as it always had, but underneath the surface, supply and demand dynamics were shifting. Physical metal was flowing from west to east. Central banks were repositioning. And then, seemingly out of nowhere, gold exploded from $35 an ounce to over $800 by 1980. The people who recognized what was happening early, who understood the supply dynamics and positioned themselves accordingly, they didn't just preserve their wealth. They multiplied it many times over while everyone else watched their purchasing power evaporate through inflation. We're seeing similar patterns today, but with even more extreme supply constraints. Back then, there were still significant above-ground stockpiles that could be mobilized. Today, those stockpiles have been largely depleted. The easy-to-mine deposits have been exhausted. The supply situation is actually more precarious now than it was then. And here's something that should concern everyone paying attention. The COMEX, the major exchange where silver futures trade, operates on a fractional reserve system. For every ounce of physical silver in their vaults, there are multiple paper claims on that same ounce. It's like a bank that loans out the same dollar to multiple people, hoping they won't all ask for it back at the same time. What happens when everyone shows up asking for their silver at once? That's not a hypothetical question. We've seen stress in this system before. In 2021, during the silver squeeze movement, the system came under pressure. Premiums spiked. Delivery delays extended. Some dealers simply stopped taking orders because they couldn't source physical metal. That was just a taste, a preview. The structural issues that caused that stress haven't been resolved. They've gotten worse. The supply deficit has continued. The vaults have continued draining. The paper-to-physical ratio has remained elevated. Now, let me address something important here. If you're sitting on significant retirement savings, $100,000 or more in traditional accounts, you need to understand how precious metals can fit into a wealth preservation strategy. I've put together a comprehensive guide on how gold IRAs work, how you can get physical gold into your retirement account without triggering tax penalties, and what you need to know about the process. You'll find that in the description below. It's worth reviewing if protecting your retirement wealth is a priority for you. But let's get back to the supply situation, because there's another dimension to this that most people completely overlook. The lease rate market for silver has been flashing warning signals. Lease rates represent the cost of borrowing physical metal. When lease rates spike, it means there's a shortage of available metal to borrow. Recently, we've seen lease rates hit levels not seen in years. That's not normal market behavior. That's stress. That's tightness. That's a market struggling to find physical metal to satisfy demand. Think about what that means practically. Large institutions that need silver for industrial purposes, they're willing to pay premium rates just to borrow metal temporarily. They can't simply buy it on the open market at reasonable prices because the physical supply isn't there. So they're paying elevated rates to borrow it, use it, and return it later. But here's the catch. What happens when the entity they borrowed from wants their metal back, and it's already been consumed in an industrial process? What happens when multiple entities all want their borrowed metal returned simultaneously? You get a squeeze, a real physical squeeze where there simply isn't enough metal to go around. We're watching this play out in slow motion right now. The signs are all there for anyone willing to look. The draining vaults, the supply deficits, the elevated lease rates, the premium expansion on physical metal, the divergence between paper and physical markets. Let me tell you about what's happening in India, because it perfectly illustrates the global supply dynamics at play. India has been importing silver at absolutely staggering levels. We're talking about year-over-year increases that are literally draining London vaults to feed Indian consumer demand. Indian buyers aren't speculating. They're not trading paper contracts. They're buying physical metal and taking delivery. They're converting their savings into tangible assets they can hold. This isn't new behavior for Indian buyers. They've been accumulating gold and silver for generations, but the scale and intensity right now is remarkable. They're buying on every dip. They're buying on every rally. They're just buying, period. And that metal is leaving the Western vaults and flowing east, where it's being absorbed into private hands and isn't coming back to market. Now combine that with what's happening in China. Chinese demand for precious metals has been robust as well. The Chinese government has been encouraging its citizens to own gold. Chinese central bank has been adding to reserves. Chinese investors are diversifying away from real estate and into alternative stores of value. You've got the two most populous nations on Earth, with growing middle classes, accumulating physical precious metals at unprecedented rates. Meanwhile, Western vaults are supplying that demand by drawing down their inventories. How long can that continue before something breaks? The answer is, we don't know exactly. But we do know it can't continue indefinitely. At some point, the vaults run low enough that the remaining holders of physical metal become unwilling to part with it at current prices. At some point, the paper market's claims on physical metal become so obviously unsustainable that confidence cracks. At some point, the supply deficit becomes so severe that industrial users start panic buying to secure their supply chains. When that point arrives, and I'm not saying it's tomorrow or next week, but when it arrives, the price adjustment is going to be swift and dramatic, because that's how supply squeezes work. They build slowly with warning signs that most people ignore, and then they resolve quickly with explosive price moves that catch everyone off guard. Let me give you another historical parallel. In 2008, during the financial crisis, there was a moment when physical gold and silver became nearly impossible to buy at any price. Dealers were sold out. Mints couldn't keep up with demand. Premiums exploded to 30, 40, even 50% over spot price. People were willing to pay massive premiums just to get their hands on physical metal because they understood that paper wealth could evaporate, but physical metal would always have value. That crisis passed, and the supply situation normalized. But the underlying lesson remained. When crisis hits, when confidence in the financial system wavers, physical precious metals become the ultimate safe haven. And if you wait until the crisis is obvious to everyone, you'll pay dearly for that metal, if you can get it at all. The smart money doesn't wait for the crisis. The smart money positions before the crisis becomes obvious. That's why central banks are accumulating now, while prices are still relatively reasonable. That's why sophisticated investors are building positions now, while physical metal is still available. They're not trying to time the exact bottom. They're recognizing the structural supply deficit and positioning accordingly. Here's something else to consider. The mining industry is facing its own challenges. Ore grades have been declining for years. The easy deposits have been mined. New discoveries are rare and expensive to develop. Environmental regulations have increased costs. Energy costs have increased. Labor costs have increased. The all-in sustaining cost to produce an ounce of silver has been rising steadily. What does that mean? It means that even if prices rise significantly, it's not like supply can just instantly increase to meet demand. There's a lag time measured in years between deciding to develop a new mine and actually producing metal from it. And that's assuming you can even find a deposit worth developing, get the permits, secure the financing, and execute the project successfully. So we've got declining production, rising costs, structural supply deficits, draining inventories, and surging demand from multiple sources simultaneously. Industrial demand, investment demand, central bank demand, Asian consumer demand, all competing for a shrinking pool of available physical metal. The paper market can create infinite claims on silver. You can trade contracts back and forth all day long, but you can't create physical silver out of thin air. It has to be mined, refined, and delivered. And right now, the world is consuming more than it's producing, year after year after year. Eventually, something has to give. Either demand has to decrease, which seems unlikely given the industrial applications and investment interest, or price has to increase significantly to incentivize more production and ration demand. There's no third option. The laws of supply and demand are immutable. Now, I want to address something that skeptics often bring up. They'll say, but silver has been in a supply deficit before, and prices didn't explode. Why should this time be different? Fair question. Here's why. The previous deficits were smaller in magnitude and shorter in duration. They occurred when there were still significant above-ground stockpiles that could be drawn down to fill the gap. They occurred before the massive expansion in industrial applications we're seeing today. They occurred before the current monetary environment of unprecedented money printing and currency debasement. The context is different now. The scale is different. The duration is different. And most importantly, the available inventory to buffer the deficit is much, much smaller. Think of it like a reservoir during a drought. If you're using more water than is flowing in, you can sustain that for a while by drawing down the reservoir. But eventually, the reservoir gets low enough that you have to ration water or find new sources. We're approaching that point with silver. The reservoir of above-ground inventory has been drawn down year after year. At some point, there's not enough left to buffer the ongoing deficit. And here's the kicker. When that realization hits the market, when it becomes obvious that there isn't enough physical metal to satisfy all the paper claims, the scramble for physical will be intense, because everyone holding a paper claim will simultaneously try to convert it to physical metal, and there won't be enough to go around. That's not fear-mongering. That's just basic math. If you have 100 ounces of physical silver and 500 paper claims on those 100 ounces, and everyone shows up asking for delivery at the same time, 400 of those claims are going to be disappointed. The only question is, which 400? The people who position early, who already hold physical metal, they won't be part of that disappointed group. They'll be sitting on an asset that suddenly becomes far more valuable as everyone else scrambles to acquire what they already own. Let me tell you about the mechanics of what happens during a physical squeeze, because it's important to understand. First, premiums on physical metal start rising. Dealers charge more over spot price because they're having trouble sourcing inventory. Then, delivery delays start extending. What used to take a few days now takes weeks. Then, some dealers stop taking orders altogether because they can't guarantee delivery. Meanwhile, the paper price might not reflect this stress immediately. The futures market can keep trading based on the assumption that physical delivery is available. But eventually, the divergence becomes too large to ignore. People start questioning why they should accept paper settlement when physical metal is commanding such high premiums. The paper market's credibility erodes. That's when things get really interesting. Because if confidence in the paper market breaks, if people start demanding physical delivery en masse, the entire structure of the precious metals market could be forced to reset at much higher prices. Not because of speculation or hype, but because of fundamental supply and demand realities that can no longer be papered over. We're seeing the early stages of this dynamic playing out right now. The warning signs are flashing, the vaults are draining, the supply deficits continue, the physical premiums are elevated, the lease rates are spiking, all the ingredients are in place. The question isn't whether this resolves in higher prices. The question is when, and how dramatic the move will be when it comes, because it's not a matter of if. It's a matter of when. The supply and demand fundamentals guarantee it. The only variable is timing, and here's what you need to understand about timing. You can't predict it precisely. Nobody can. What you can do is recognize when the odds are heavily skewed in one direction and position accordingly. Right now, the odds are heavily skewed towards significantly higher precious metals prices over the medium to long term. The supply situation alone guarantees it. So what should you do with this information? That's ultimately a personal decision based on your individual circumstances. But I can tell you what informed investors are doing. They're accumulating physical metal while it's still available at reasonable prices. They're not trying to time the exact bottom. They're building positions systematically, understanding that the long-term trajectory is clear, even if the short-term path is uncertain. They're diversifying their wealth into assets that can't be printed, that have intrinsic value, that have served as money for thousands of years. They're not putting all their eggs in one basket, but they're making sure precious metals are part of their overall wealth preservation strategy. Because here's the ultimate truth. Paper wealth is only as good as the system that backs it. When that system is running massive deficits, printing currency at unprecedented rates, and accumulating debt that can never be repaid, the value of that paper wealth is at risk. Physical precious metals represent an alternative, a hedge, a form of wealth that exists outside the system and can't be devalued by monetary policy decisions. The vaults are emptying. The supply is non-existent relative to demand. The structural deficit continues year after year. The warning signs are everywhere for those willing to see them. The question is, will you recognize what's happening and position accordingly, or will you wait until it's obvious to everyone and pay the price for that delay? History shows us that the people who recognize major shifts early, who position before the crowd, they're the ones who preserve and grow their wealth through turbulent times. The people who wait for confirmation, who need absolute certainty before acting, they're the ones who end up paying premium prices or missing the opportunity altogether. The choice is yours. But the supply situation isn't going to improve on its own. The deficits aren't going to magically disappear. The vaults aren't going to refill themselves. The fundamental dynamics are clear. The only question is whether you'll act on that information while there's still time to position at reasonable prices, or whether you'll wait and hope that somehow, despite all the evidence, things will just work themselves out. The vaults are empty. The supply is non-existent. And the implications of that reality are going to reshape the precious metals market in ways that most people aren't prepared for. Make sure you're not one of them.